For nearly 20 years, Chris Wallace with WG Financial Group has been helping families here in the Huntsville area plan for a successful retirement. Chris strives to understand all of your financial needs to help guide you on the path to your retirement goals, creating income in retirement, maximizing your savings, and minimizing taxes. Chris has the strategies you need to help you sustain a successful retirement. Welcome to the Rocket City Retirement Show with Chris Wallace.
In life, there are many things that you can't control. The good news is there are some things you can control, and that includes how much you'll pay in taxes. On today's show, you'll learn how to keep more of your hard-earned money and give less to Uncle Sam. Thanks for joining us today on the Rocket City Retirement Show with certified financial planner Chris Wallace of WG Financial Group. Chris, it's so good to see you again.
Yeah, it's good to be here as well, Luann.
Now, control. I think we all like it. I know you kind of like to be in control of things, don't you?
Yeah, it depends. I think there's an element to everybody as far as control goes. I mean, people like to control certain things, absolutely.
Now, we can't control the weather, unfortunately. So when we have plans for outdoor, we can't count on the weather. Market, you can't control the market. Can't control that traffic jam that you hit when you're late going somewhere and you're stuck in traffic. Can't even control your spouse, We can't. Sometimes we wish that we would, but many people think that when it comes to retirement that we have no control in how much we're going to pay in taxes, right, to Uncle Sam. But you say that that's not entirely true.
No, it's really not. I think, when we talk about taxes in general, so let's just talk right now about like if you're working out there, you're watching the show, taxes just like automatically happen, right? So you get your W-2. We used to get a paper
Right,
W-2.
we did.
Not W-2, check stub. I said W-2.
Yeah.
You get that paper check stub. Nowadays, it's all electronic, so nobody really ever looks at it. But, your federal comes out, your state comes out, your FICA comes out. You don't ever really think about it. And when you get into retirement, you're responsible for doing those, tax withholdings. Now, you're not going to pay FICA in retirement, but you will pay federal and state on certain accounts. So I think it's important to understand what you can do to try to minimize the amount of taxes you're going to pay.
Right. My son just, got his first job now. He's a doctor, but he was very surprised at how much taxes were taken out of his first paycheck.
Yeah, you should have heard my daughter.
Right?
When she started working at 16 and she got her check and she's like, Dad, the math doesn't work. And I'm like, what's wrong with the math? She's like, well, I work this many hours, I get paid this much per hour, and I only brought home this much. I said, let's sit down and let's take a look at this. And so FICA got her, 7.65% she was missing.
So let's talk about the impact that taxes can have in retirement. So many of us don't realize that it really could be one of our biggest expenses.
Oh, it absolutely can. And again, like I said earlier, when you're working, you don't really think about it. But when you're retired, you're going to be responsible for at least trying to understand how your money is taxed. So let's just take, for example, how the different types of accounts are taxed. So we have pre-taxed IRA or 401k money. So if you're working every paycheck, hopefully you're putting something in your 401k or your IRA, and that money sometimes will go in pre-tax, and that you're not going to pay taxes today, but you'll pay taxes tomorrow when you pull it out. And then you also have what's called Roth money, and a lot of 401k plans today have a Roth option inside of them, and so that money is going to go in after tax. So you'll go ahead and pay the taxes on it today, and in the future, when you go to pull it out, you will not pay taxes at that point. And then you have these like after-tax investment accounts. We tend to call them brokerage accounts. They're non-IRA, and they fall up under a whole different set of tax rules, and that's called capital gains taxes. But then you also have Social Security. And then because you've done the radio show with me for a long, long time, Social Security is taxed more favorable. So for the retiree out there today who's getting ready to retire, getting ready to make those Social Security decisions, it's really, really important that you take into consideration how Social Security is taxed. Because if you just have Social Security alone, you already know the answer to this, but if I asked our audience out there, if you just have Social Security and that's it, let's say you have $40,000 of Social Security, what tax bracket are you in? You're in 0 federal, 0 state. It's the other pieces of income that you add on the tax return that then causes Social Security to be taxed, and it can be taxed up to 85%. So 85% of your benefit can be taxed again. So basically with an IRA, it's subject to 100% of taxation. So Social Security has a more favorable tax position. Again, I'm not a CPA, but talk to your CPA about this because you need to look at how income goes on your tax return and how it all stacks together and then causes you to pay or more tax or less tax.
I love how, you're not a CPA, but you certainly understand how all this works, especially in retirement. And, one of the things we talk about is, put your money in a Roth, okay, Roth IRA.
Right.
But I want you to tell us the difference between a traditional IRA and a 401k versus having your money in a Roth.
Yeah, so let me go back to something you said. You're exactly right. I'm not a CPA. You're not, but as an advisor, you better understand how money's taxed and how it works if you're going to be advising people. So I take that very seriously, but I always recommend that somebody sit down with a tax person, accountant, CPA to go over their tax situation. So in terms of, what's the difference between a traditional Roth IRA and a traditional IRA? So really today, if you put money in a Roth, you're going to pay taxes today. And again, as I said earlier, if you pull it out, there won't be any taxation on it. The pre-taxed IRA, the traditional IRA, you're going to defer the taxes until later down the road. Now, a lot of people, my dad was one individual that said, hey, Chris, I think I want to put everything in a Roth. So he retired and he says, hey, I want to convert everything to a Roth. And I'm like, hey, wait a minute. If you do a conversion, that creates a taxable event today, and on this amount of money, you don't want to pay Uncle Sam the amount that he's going to be asking for if you convert it. But in situations, I think Roth makes a lot of sense. So I'll give you a really good example. If you're in your younger, not peak earning, years, so let's say you're in your 20s, in your 40s to 50s, you're probably going to hit the peak earning years at that point. But in your younger years, when you're making less money, I think it makes a lot of sense at that point to start looking at the Roth option and start building that tax-free money for the future. And as you age up and as your income increases, there's probably going to be a need at a certain point to do some deferral of some of those taxes and use the pre-taxed option. So my order of operations, as I like to call it, we went to school, I learned off PEMDAS. Please excuse my dear Aunt Sally. That was the acronym that they came up with, and I'll never forget it as long as I live. Please excuse my dear Aunt Sally. So that's the order of operations to solve a math equation. Well, I think you have that order of operations when it comes to saving money. So again, when you're younger, think Roth. As you age up, you're probably going to want to look at a little bit of pre-tax. Some people are going to argue and say, I want to stay all Roth. Hey, that's up to you. And then if you have leftover money, then you want to start looking at an HSA. And then if you have leftover money from that, maybe you look at that after-tax brokerage account. That way you're creating multiple tax buckets for your future. And I'm sure we'll talk about this because this show is going to be about taxes, and I love to talk about taxes.
I know.
Because it's the thing that really aggravates people the most, and it's the thing that intimidates many, many people. I sit with a lot of engineers here in Huntsville, Luann, and taxes is the biggest mistake where I see them make. And they're spreadsheets, because they all come in with spreadsheets. Engineers, right? If you're a wife watching the show, your husband's probably on his computer right now doing an Excel spreadsheet somewhere. So usually I see errors in the tax area, and it's usually they're figuring too much tax because they don't understand how the retirement income they have is actually taxed.
Okay, great. Great information on all of this. And you didn't even have to check with a CPA. You just know all this.
Yeah, well, I work with CPAs, so I've learned a lot from them for sure.
Right. The bad news is taxes can be a big expense in retirement. The good news is you have options to help lower your bill. Chris explains that and more coming up next. But first, here's how you can reach the team at WG Financial Group.
Just when you may want to forget your age, Uncle Sam says not so fast. Knowing your age is more important than ever when it comes to taking your required minimum distributions, or RMDs. Legislation just changed the age requirement, and not accounting for that could impact your retirement plan. It could be key to not overpaying on taxes in retirement. So remember, when it comes to RMDs, age is more than just a number. Before your next birthday, call today to secure a strategy for the RMD age change and your retirement.
You're watching the Rocket City Retirement Show with Chris Wallace.
Did you know taxes could be your largest expense in retirement? It catches a lot of retirees by surprise, but there are ways to potentially lower your tax bill. Chris, tell us the difference between tax planning and tax preparation, because that's something that people don't realize. There's a big difference.
Oh yeah, tax preparation is what you're doing on April the 14th. You're freaking out. The deadline's there, and you're like, oh, honey, I got to get my taxes done. I got to sit down. We got to do our taxes tonight. It's got to happen tonight. tax planning, or tax preparation rather, what you're doing at the last minute, that's historical. So you're literally doing your taxes, and you can't change history, because all of those things that are going to be on your tax return, they already happened. So you're literally having a historical discussion about taxes at that point.
You're looking back at the
Absolutely.
last year. Yeah.
Tax planning is looking forward, looking at all your sources of income if we're talking about retirement, where I'm going to pull from, what's my Social Security strategy going to be, and how am I going to take income out of each one of those buckets and put it on my tax return in the most efficient manner possible. That's tax planning. So preparation is historical, planning is forward-looking.
All right. And to make sure that we can still live that lifestyle that we were dreaming of in retirement, the same one that we had prior to retirement.
Yeah,
Very
absolutely,
important. Yeah.
absolutely.
So, all right, let's talk about some tax saving options that we have.
Yeah. So there's a lot of them out there. So I think a lot of people, we talked about this before, they just take for granted that, oh, I'm going to pay taxes. But the IRS has a tax code, and it's a lot of pages.
It's a lot.
A lot of pages. And in those pages are things that you can legally do. So let's talk about some of the things that we could do today if you really wanted to save taxes. So I'll give you some examples. Let's say that we have a 45-year-old couple, maybe 50-year-old couple. I'm sure we have viewers out there that are that age. And let's say they have a really high income. They may want to consider doing a little bit more pre-tax. Now, I know I have a lot of people throwing things at the TV screen right now saying, no, Chris, taxes are going up. You don't want to do pre-tax. But if you're in the 32 bracket today, 32% tax bracket, that's a lot of taxes you're paying today. And the chances of your bracket dropping down in retirement is, I think, a decent probability for most people. So for tax savings today, you may look for more pre-tax dollars going into your retirement savings plans. The other thing that you could do, and this is a great area for a lot of people, it's one of mine that's near and dear, is giving. So if you have an after-tax account with appreciated stock in it, you may want to look at gifting some of those appreciated assets. Now, what does that do for you? Number one, that gives you that charitable deduction, because people are going to give with their heart first, because that's what we're supposed to do. It's a heart condition, not an IRS condition, right? So we give from the heart first, but one of the benefits is we get that charitable deduction. And when you're gifting an appreciated asset, you get that charitable deduction, and it also reduces the gains that you have in your after-tax account. So let's say you had, let's just say $10,000 of gains in an account somewhere, maybe with let's just say Apple. Everybody loves Apple, right? So maybe you've got a Apple stock or several shares that have appreciated to $10,000, and you gift away $5,000 of that. You get the tax deduction still for the market value of the stock today, and then you've also reduced your gain in that account. And guess what? You get to keep your money that was in savings or checking. You don't have to spend that. And you've done, a great tax move, I feel, for your family situation by gifting away some of those appreciated assets.
Because you talked about that 45-year-old couple, right? Yeah. But all right, let's get to people in retirement and how they can still save on taxes.
Yeah, that's a great question. I'm glad you actually pointed that out. I meant to kind of lead into that earlier, and I got really zoned in on the 45-year-old couple. Yeah, so let's say you're in retirement. There's still several things that you can do in retirement. Number one, we talk about Social Security being more tax favorable. It's important that you make a very solid data-driven decision on Social Security and when to claim, not the break-even. A lot of people are watching saying, honey, look at this. I ran a break-even analysis in my Excel spreadsheet, and guess what? It's 90 years old before I break even. No, that's not the case. You need to look at Social Security from a tax perspective because it's taxed more efficiently. So that's one thing in retirement that you can do. The other thing that you can do is you can still gift some of that appreciated stock in retirement as well. So that doesn't just apply to the 45 or 50-year-old couple.
Okay.
If you have appreciated stock in retirement, you can also do that. The other thing that you can do is if you're over the age of 73, because we all know now with the Secure Act 2.0, there's been some law changes.
Right.
If you're, if you're 70 and a half, you can do what's called a QCD. That's a Qualified Charitable Distribution. Now, most of my clients will elect to use that when they have to start taking required minimum distribution. Okay. So let me walk through an example of how this works, okay? Because this has to be done the correct way or it doesn't work the way it's supposed to from the IRS standpoint. Okay. So let's say that you have to pull $20,000 as a required minimum distribution. What you can do is you can gift money to, like, say, your church.
Right.
It has to be a 501c3. That's the key thing. Well, most churches are grandfathered in under the 501c3 guidelines. So you can send money directly from your IRA to that charitable organization. And let's say you're going to do $10,000. You had to pull 20 as a required minimum distribution. So you send 10 to the church, and then you still have to pull 10. So you pay taxes only on the 10 that you pulled. You do not pay the tax on the charitable distribution. That's huge.
Huge, yeah.
It's absolutely huge, because what that does, Luann, is that reduces your gross income. And if you want to learn how to pay less taxes early in life or late in life, it's called reducing your gross income. That's one way to really do that, is to take advantage of that charitable distribution out of your IRA. Now, again, it has to be done correctly. It's not an itemized gift. It'll ask you on your tax return, did you do a QCD? You have to note that you did it, how much you did it, but it has to be done properly. I would highly advise two things as we continue to talk about taxes. Talk to a CPA or a tax person. Make sure that you're, discussing, these options with them, and make sure that you're working with a qualified financial professional who can walk you through how to do these things. I know that we do the forms at the office for our clients. We have a very, big client base, and a lot of clients give a lot of money, and especially when they're doing their RMDs, we encourage them to use the QCD process, because that allows them to save on taxes. It satisfies their giving. Now, here's what I'll tell you also with that. I usually tell clients to plan out their giving. So in 2023, I've already talked to several clients.
Okay.
I say, go ahead and plan your giving out so you know what you're going to give to clients give to your organizations moving forward. And then you just let them know, hey, listen, you're going to get a donation. I'm not going to be putting something in the offering plate every week this time. I'm doing a qualified charitable distribution. You're going to get a lump sum, and that's going to take care of my giving for the entire year. Now, guess what? Let's say they come up with a mission opportunity, and they say, oh, hey, we want you to support missions. Great, do another QCD, because you still can do that. So you can do multiple QCDs every year, but most of my clients will do, one big lump sum and take care of it.
Yeah, and the key is, don't take it out and put it in your checking account. It has to go straight to the charity. Yeah.
Very good point.
Yeah.
That's absolutely correct.
Okay, very good. Well, so often we're focused on saving for retirement, right? But it's important to have a strategy for taking money out of your savings in retirement, and that's where taxes can really have an impact. Chris is going to explain all that next. But first, here's how you can reach the team at WG Financial Group.
Congratulations, you did it! You worked hard and saved for retirement, but now you have questions. Could my taxes increase? How will I cover my expenses? Will my income last? You need a strategy to help make sure your hard-earned money goes the distance in retirement. That's why we're offering this free guide designed to help you determine if your nest egg can withstand the challenges of a 21st century retirement. Longer lives, increasing healthcare costs, and taxes are just a few of the possible risks to your income. Get the guide today and take the first step to help your money last in retirement.
You have a club for every scenario. A driver for the long holes. Wedges to get you over the hazards. And a putter for when you need a touch of finesse. What about your retirement? Will you have enough to play the back nine? Call to set your 15-minute phone visit today, and let's find out. Get a second set of eyes on your retirement plan.
You're watching the Rocket City Retirement Show with Chris Wallace.
Thanks for joining us today on the Rocket City Retirement Show. So often we're focused on saving for retirement, but it's important to have a strategy for taking your money out of your savings in retirement, and that's where taxes can really have an impact. So Chris, why is it so important to have a strategy of taking money out of our retirement accounts?
Well, I don't think anybody wants to pay unnecessary taxes, right? I mean, if you have the option to do things more efficiently, I mean, wouldn't you do that? I mean, you and I, we love to buy clothes.
Right.
I mean, I'm ashamed to admit it, but right here on TV, take my man card, whatever. I like to shop, and I always like to shop on sale, and I like to go to the clearance racks.
Yeah.
So that's what I call Mr. Clarence. If Clarence has something for me, then I'm more likely to buy it. For me, that's an efficient way to buy clothes. It just saves me money. So I think when you look at taxes, you have to think about that as well. There are efficient ways to do that, and I just think it's really important that people take that into account when they start taking income out of their retirement portfolios.
Chris, what about required minimum distribution, or RMDs as they're called? I want you to talk about this just a little bit more and how much effect these can have on our taxes.
Yeah, so a lot of people have deferred money for a number of years, right? So we've been stuffing money in a 401k for a long time, and then at 73, because it just changed, it went from 70 and a half a couple years ago, which to me it never made sense. I was like, why didn't you just make it one?
Half?
Yeah, half. Why didn't you just make it around,
Right.
even year? So now it was 72, and now it's 73. Okay, so if you turn 73 this year, you're going to have to take a required minimum distribution. Now, what that can do for people, because you've been deferring for a long time, is that can cause a spike in your income. And in some cases, it can push you up to another tax bracket. But then there's the other thing, if you don't pull it, there's a penalty if you don't pull it. So
That's right, and the penalty actually has gone down. It was 50%, now
did.
it's down.
It did. It's not a 50% penalty. It's the 50%, well, it's 25% now, but it's 25% on the amount you didn't take.
Okay.
So you have to understand how the languaging works there, because I've heard that misquoted by a lot of people, advisors in general.
Yeah.
So it's 25% on the amount that you didn't take.
Yeah.
But that's pretty stiff, if you think about it.
It is.
You still got to pay the taxes, and then you got to pay the 25% penalty on the amount you didn't take. Now, if that ever happens, so I'll just give our viewers a tip, because we're all about teaching people on this show. If that were to happen and you make a mistake and you just didn't pull enough or you forgot, you can go to your CPA, talk to them about it. There's probably a form that you can fill out with the IRS, put a letter with it, and maybe there's a little bit of forgiveness. But I'll leave that conversation up to you and your CPA if that ever happens. The best thing to remember is take your required minimum distribution when you're supposed to.
Right.
Work with a financial professional that's going to remind you and actually push you to take it. But then do those efficient things that we've been talking about on the show before.
Now, how do you remind your clients? Do you have to call them up every year or send out an email? Hey, don't forget.
Yeah, so we have a list that we run. People that have birthdays that are going to be, turning like 73 this year. We'll be talking to our clients and getting them ready to, prep them on what they need to do, talk about the options that they have, because we've talked about some options on the show today, the QCD being one of those. But that's how we do it. We have a list, and we kind of help them with it.
Sure, awesome. So what if your current advisor is not forward-looking and not looking at tax-efficient strategies for your retirement? What should someone do?
Yeah, so I think when you talk about retirement in general, and I brought a little present today, a little Rubik's Cube.
You totally surprised me.
Yeah.
Your Rubik's Cube.
Yeah, you didn't know I had this, right?
I did not know you
Well,
had
notice
it.
it's the same on all sides.
Wait a minute.
Oh, absolutely. I had a client come in the office and fix it.
Oh my gosh. And did it?
I'm-
You didn't do that?
No. No, I'm sitting there talking to him, and it's a little bit distracting as he's cranking on it. And I'm like, he's not even listening to me, and he really wasn't. And so I noticed that he kept getting the colors more and more uniform. And I looked at his wife, and I said, is he going to solve that? And she said, oh, he'll be done in about a minute. And literally in a minute, it took him a total of about 2.5 minutes. He got it all solved out. The reason I bring this up, this is really important when it comes to taxes.
Yeah.
Because how you pull money out of the portfolio is incredibly important, because you can cause more of your Social Security to be taxed. But you're pulling from your IRA.
Right.
And when you turn that, think of that as I'm pulling from my IRA.
Take your
I'm
money out.
affecting this over here, and
Yeah.
I can't see this side, right? So that's why I call it the Rubik's Cube. Or maybe you sell a house and you've got all these capital gains, and you say, okay, great, honey, we made $200,000, capital gains on our house.
Right.
And that money, we're going to be able to just pay the capital gains on it, and we'll be fine. But what you can't see over here is something called IRMA, which is your earned income monthly adjustment amount, because you made too much money and it causes your Medicare premium to go up. So I like to look at retirement not like a puzzle. Some people do. I've seen a lot of advisors say, it's the retirement puzzle, the retirement jigsaw puzzle. Everybody's got their own name.
Right. Yeah.
I like the Rubik's Cube analogy, because when I'm trying to solve that Rubik's Cube, I don't really know what I'm doing. I'm twisting that Rubik's Cube, and I'm turning, and I can't see what's happening on the other side. And a lot of times that's what happens in retirement. People aren't trained to know about the tax code and how to pull money out, and that one of their accounts may be taxed under the capital gains. And if you do that properly, and if you're in a low enough tax bracket, you actually can pay 0% capital gains. But when you start stacking money on that tax return, I think a family has to be really conscious about that, because there's some things that you can impact, like I mentioned a few minutes ago, the IRMA limits. So what that does, so I'll just quickly explain that, there's several levels to IRMA.
Okay.
So depending on how much money you make in a given year, you may pay a really sizable amount more on your Medicare premium. But not just your Medicare premium, it also hits your Part D prescription plan as well. That also increases. There are people out there today watching the show that had no idea that that even exists. But it does, and it's put there, so if you make more money or put more money on your tax return, you're going to pay higher Medicare premiums. And I used the example when I had the Rubik's Cube out. I talked about capital gains on the sale of a house. That happened to somebody that I talked to, and he sold a rental property, and he made a big chunk of money. And I said, wow, you've hit the IRMA limits. Right. And he's like, no, this is capital gains money, Chris. I sold a rental property. This is capital gains. It don't matter, because it all goes on your tax return. Right. And that's what Medicare is going to look at in terms of figuring out what your Medicare premiums are going to be in the future. And here's the deal. Once you bust the IRMA limits, you're stuck there for 2 years, because it's a 2-year look back. So you'll have increased premiums for a couple years. Now, in the following year, if you get your income back up under the IRMA limits, then you'll eventually go back to normal, but it's always going to look back 2 years when it comes to IRMA. So again, a lot of moving parts when it comes to like how taxes work in retirement. It's a whole lot more complex than when you were just working and the federal came out, the state came out, the FICA came out. All of it happened automatically, and usually you got a little money back at the end of the year, and you're like happy because you can take your family on vacation or whatever. You just never thought about it. It just automatically happens. It's a different ballgame in retirement for sure.
So different, and I can't imagine people doing it on their own with all these different details to know. So it's so good to get a second opinion from someone like you, Chris.
It's about being efficient.
Right. Well, that is all the time we have for today. Thank you so much for joining us. If you want to learn more about how to generate lifetime income, reduce your tax bill, and maintain your lifestyle in retirement, reach out now. Start planning for your ideal retirement. For Chris and the team at WG Financial Group, I'm Lou Ann Fulmer, wishing you a healthy and happy journey to and through retirement.
This program was sponsored by WG Financial Group, where your retirement matters.